You're 28 years old. You've been grinding for 5 years, 2 jobs for a while, cutting everything that wasn't essential, watching every dollar, and your savings account just crossed $50,000 for the first time in your life. You found a place, 3 bedrooms, solid neighborhood, $430,000. Your real estate agent is already in your ear. This market moves fast. If you wait another month, this is gone. Rates could go higher. Your mom calls every other week asking when you're going to stop wasting money on rent. Your older cousin bought 3 years ago and won't shut up about it at every family gathering. Equity this. Locked in rate that. Posting pictures of their backyard renovation like it's a personality. And you're sitting there with your $50,000. Running these numbers for the 100th time, trying to figure out if you're being smart or if you're just scared. Because here's what the numbers actually look like. At 6.5% interest with 20% down, that's $86,000 on a $430,000. Your mortgage payment comes out to around $2,170 a month. Then you add property tax, roughly $400 a month. Insurance, call it $150. Maintenance, the standard estimate is 1% of home value per year, so another $358 a month. You're at $3,078 a month before you've bought a single piece of furniture or fixed the first thing that breaks. Your current apartment, that's similar size, same area, is $2,100 a month. Your gut says renting is the smarter move right now. But everyone around you is calling it a mistake, throwing money away, never going to build wealth if you keep renting. So here's the question that's keeping you up at night. Which one is actually cheaper? And here's what nobody's going to tell you. There's a simple rule that answers this question in about 30 seconds. It's called the 7% rule. And once you understand it, you'll stop listening to real estate agents, stop listening to your family, and start making this decision based on actual math instead of pressure. From people who either make money when you buy or just want to feel like their choices were right. My name is Marcus, and I spend a lot of time thinking about why people make the worst financial decisions of their lives, because someone told them renting is throwing money away. Quick note before we get into it, nothing in this video is financial advice. This is purely educational. I'm here to break down the math so you can make better decisions on your own. If you've ever felt pressured to buy a house you weren't sure you could afford, or you've been told you're being stupid by renting, stick around. Because today we're breaking down the rent versus buy decision using real 2026 numbers. And the answer might not be what you've been told to expect. Let's get straight to it. Here's the lie. When you rent, you're throwing money away. When you buy, you're building equity. Sounds good. Completely wrong. Because here's what they don't tell you. When you own a home, you're also throwing money away. Every single month. You're just throwing it in different directions. According to 2026 housing market data, renting is increasingly looking like a strategy rather than a setback. And there's actual math to prove it. Let me show you what you're actually paying for when you build equity. The 3 costs of home ownership. When you own a home, you have 3 major costs that disappear forever, just like rent. Nobody talks about this, but these are the real throwing money away costs of ownership. Cost number 1, property taxes. You own the house, but you still have to pay the government a percentage of its value every single year. In the US, the average property tax rate is about 1.11% of home value annually. On a $500,000 house, that's $5,550 per year, $462 per month, gone forever. You're not building equity with property taxes, you're paying the government for the privilege of owning property. Cost number 2, maintenance. Experts recommend budgeting 1% to 2% of your rent fees. Your home's value annually just for maintenance. Let's use 1% to be conservative. On a $500,000 home, that's $5,000 per year. $417 per month. For the roof that will need replacing, the water heater, the foundation crack, the plumbing disaster at the worst possible time. This money disappears. You're not building equity by fixing a broken furnace. You're just keeping the house from falling apart. Cost number 3, the cost of capital. This is the part nobody explains clearly, so pay attention because this is where the 7% rule actually comes from. Your money has something called opportunity cost. When you put $100,000 into a down payment, you're not investing that $100,000 in the stock market where it could be growing. Historically, the S&P 500 has gained an average of 10% per year over the past 100 years. Meanwhile, homes traditionally appreciate by 4% to 5% each year. The difference? About 5%. That's the opportunity cost of your down payment, the returns. You're missing by tying up money in a house instead of investing it. Plus, you're paying mortgage interest on the remaining 80% you financed. At current 2026 rates of around 6.5%, that's substantial. Let's do the math on a $500,000 house. 20% down is $100,000. You're financing $400,000. The opportunity cost of the down payment at 5% is $5,000 per year. The mortgage interest at 6.5% on $400,000 is roughly $26,000 in the first year. Combined, that's $31,000 per year, or $2,583 per month in capital costs alone. Now, let's add it all up. Property taxes 1.11% plus maintenance 1% plus opportunity cost and interest 5% equals approximately 7% of the home's value annually. This is the 7% rule. To find out how much home ownership actually costs you per month, take the home price, multiply by 7%, and divide by 12. $500,000 times 7% equals $35,000 per year. Divided by 12 equals $2,917 per month. That's how much you're throwing away every month as a homeowner. Money you will never see again, just like rent. So if you can rent a similar house for less than $2,917 per month, renting is financially superior. Take the price of a house in your area right now. Multiply by 0.07, divide by 12. That's your break-even rent. Is renting cheaper where you live? Drop your numbers in the comments. Now let's talk about what's actually happening in 2026. Because the numbers are brutal. Mortgage rates are averaging 6.3% for the year, according to Redfin's forecast. That's down slightly from 2025's 6.6% average, but nowhere near the 3% pandemic rates everyone keeps comparing to. Some optimistic predictions put rates in the low 6% range occasionally, but no one is expecting them to stay below 6% for any meaningful period. And home prices? Zillow economists expect U.S. home values to grow 1.2% in 2026, while Redfin expects the median U.S. home sale price to rise about 1% year over year. Homes are getting more expensive, rates are staying high, and buying remains unaffordable for a lot of people, especially anyone buying for the first time. But here's what's interesting about rents. As of late 2025, median rent prices had declined year over year for 26 straight months. Rental affordability is actually improving while home buying affordability stays difficult. Nationwide, rents are expected to rise about 2% to 3% year over year by the end of 2026, roughly the pace of inflation. That's manageable. Meanwhile, home ownership costs are locked in at whatever rate you buy at today. Look, I'm not saying buying is always the wrong call. I'm saying it's the wrong call right now for most people in most markets. Buying makes sense when you're staying put for 10 or more years minimum. Transaction costs eat you alive on short timelines. It makes sense when the 7% rule actually works in your favor, meaning monthly ownership costs are significantly lower than comparable rent. It makes sense when you have a massive down payment, 30% to 40% or more, which reduces both your mortgage and your opportunity cost dramatically. It makes sense if rates ever drop to 4% or below, because at 3.5% mortgage rates, buying becomes financially superior to renting in many scenarios. And it makes sense if you value the intangible benefits enough to pay for them. Fixed housing costs, complete control over your space, emotional roots, those are real, but they cost real money. But here's the problem. Assuming an 8% average annual investment return, renting actually comes out ahead by about $120,000 over a decade in many current market scenarios. Let me say that again. Over 10 years, renters who invest the difference can end up $120,000 richer than homeowners in equivalent properties. That's not a rounding error. That's life-changing money. Now, homeowners watching this are getting defensive. But equity, but forced savings, but tax deductions. Let's go through these. But I'm building equity. You're also paying interest. In the early years of a 30-year mortgage, most of your payment is interest. At 6.5% on a $400,000 loan, you're paying roughly $2,167 per month in interest in year one. You're building maybe $400 to $500 per month in actual equity initially. Meanwhile, the renter investing that difference is building actual liquid wealth they can access without selling their home. But it's forced savings. You know what else is forced savings? Automatic investment contributions. Set up an auto transfer from checking to a brokerage account. That's it. Forced savings without the illiquidity, the transaction costs, and the risk of a housing market downturn. But tax deductions. The standard deduction in the U.S. is now $14,600 for individuals and $29,200 for married couples. Unless you have significantly more than that in mortgage interest to deduct, the tax benefit is minimal to non-existent. And even when you do get a tax benefit, it doesn't outweigh the opportunity cost and transaction costs of homeownership. But rent keeps going up. So do property taxes. So does insurance. So does maintenance. Your mortgage payment is fixed, but your total housing cost absolutely is not. Here's where I'll be fair to homeownership. There are real benefits that don't show up in any spreadsheet. Benefits of owning. Predictable housing costs with a fixed mortgage, complete control over your space, you can't be evicted by a landlord, inflation works in your favor over the long term, emotional stability and roots. But there are also real intangible costs that nobody talks about. You're locked in. You can't move easily when a career opportunity shows up somewhere else. You're responsible for every disaster. Burst pipe at 2 a.m. That's entirely on you. You're illiquid. Your wealth is trapped in walls and can't be accessed without selling or borrowing against it. And you're concentrated. Most of your net worth sitting in a single asset in a single location is a significant amount of risk. 52% of American renters prefer renting over all of the expenses and responsibility of ownership. 36% plan on renting permanently, according to NerdWallet's 2025 Homebuyer Report. That's not failure. That's people doing math and choosing freedom over being house poor. Based on mortgage rates staying in the low 6% range in 2026 and current home prices, renting is financially superior in most major U.S. markets right now. With many Americans still locked out of home ownership by high down payments and expensive monthly mortgage payments, rental demand will stay elevated. The math is clear. In 2026, unless you're getting an exceptional deal or rates drop dramatically, renting and investing the difference will leave you wealthier after 10 years than buying. But here's what you need to understand. This isn't permanent. Markets change. Rates move. The 7% rule gives different answers in different years. That's why you need to run the numbers for your situation in your market at the time you're making the decision, not when your parents bought in 1995. Not when your friends bought in 2020. Right now. Today, with today's numbers. Here's what I want you to walk away with. Renting is not throwing money away. Buying is not automatically building wealth. Both options involve throwing money away every month. The only question is which one throws away less. The 7% rule gives you that answer in about 30 seconds. Home price times 0.07 divided by 12 equals monthly break-even rent. If you can rent for less, rent. If ownership costs less, buy. If this video saved you from making a $500,000 mistake because everyone around you was saying, stop throwing money away on rent, share it with someone who's getting pressured to buy. Drop a comment with your break-even rent calculation for your market. I want to see those numbers. And remember, the person telling you renting is throwing money away probably gets paid when you buy. Your real estate agent gets a commission. Your mortgage broker gets a commission. Your family wants the social satisfaction of being right. Nobody gets paid when you make the smart decision. That's why you have to do the math yourself. Now go run those numbers. Your bank account will thank you. See you in the next one.